This is my opinion, and I cannot prove this, but I think the launch of the euro in some ways helped to weaken the US dollar. The reality is the US does not want the dollar to be too strong because a really strong dollar crushes the global economy. If the dollar rises, you're going to have deflation and assets are going to fall. What you need is the dollar either trading within a band or generally falling over time for the global economy to keep working. And so the fact that the rise of the euro, that was another place for people to park some of their reserves, which took some of the upward pressure off of the dollar. Remember, in the mid-80s, the reason the dollar came down so much from the mid-80s to early 2000s, because it was systematically weakened on purpose via the Plaza Accord. When you look back across the last 40 years, all of the major programs that the Federal Reserve and the government took with regard to the dollar was efforts to weaken the dollar, not to strengthen it. And it's because a strong dollar puts a chokehold on the global economy. That also, though, gives the United States a tool to put pressure on the rest of the world. So if and when they do want to choke a part of the world, all they have to do is make a move to temporarily strengthen the dollar, and the rest of the world gets choked out very quickly.
This is a 50-year chart of the U.S. dollar to kind of prove your point. If you go back and look at the dollar historically, this is the U.S. dollar index. And when you take a look at the dollar, it is always the dollar relative to something else. So the only way to say, the dollar is strong or the dollar is weak, in isolation, you can't say that. You have to compare it to something else. So it's the dollar versus the franc. It's the dollar versus the British pound. It's the dollar versus the euro. So it's always compared to something else. So when you look at the U.S. dollar index, it's the U.S. dollar compared to a basket of other currencies. And historically, what you'll notice is that the dollar trades around 100. That's kind of the fair value. And the dollar currently is trading exactly where it was back in 1970. So for all these fearmongers going, oh, the dollar's losing its value, everybody's getting out of the dollar. Well, it's kind of hard to say because when you look at the actual chart, the dollar's been rising steadily since 2008, since the financial crisis, and is back at fair value. And again, to Brent's point, importantly, if the dollar is trading weak, in other words, it's trading below 100, just as an example in this case, then that is a impact on transactions between countries. So if the dollar's too weak, that impacts trade because for us, if the currency is stronger in another country, they're able to buy our goods cheaper using their currency. If the dollar's too strong, it works in the other direction, right? It's inflation on them because their currency is weaker than ours and it's costing them more to buy the goods or services from the US. Understanding that this relative relationship is very, very important, not only just to reserve currencies, but also to global trade, global economics, and there's very big impacts because of that.
Watch the full interview by clicking on the link below.